Welcome back, people. So we kind of understood all the investing stocks, ready-made stocks. I gave you a list of ready-made stocks. You simply can take those, create your own SIP plan, and then kind of start doing that. Is one. Now beyond those stocks, let's say there were from all the Ritik and Bharat stocks and everything, maybe you had around 20-25 stocks there. Beyond that, I also want to share with you a investing system. Now this is a very, very powerful investing system which even Warren Buffett used. That's what it's been told, that's what it's been written in many books, and this was propagated, and he learned this from one of his very close friend who's the father of investing. He's called as the father of investing. Who is that person? What that system is all about, and why is it called value investing? We'll kind of learn that in here. So if you're ready to kind of understand and get on to the value investing system, type in the comment value investing. Type in the comment value investing. Awesome. Let's kind of jump on here. Now this is investing system in value investing, right? This was propagated by Benjamin Graham. He's the author of this very famous book called The Intelligent Investor. If you have not read, if you have not heard it, you can buy this book, and if you have the time to kind of read it, you can read it. It's a very, very fat book, and there's a lot of concepts he's spoken about the investing per se. So this is one of the best investor advisors the world has seen, and Warren Buffett followed his methods of value investing in building his massive wealth, right? So it is such a simple thing, but disciplined way of doing it is what made Warren Buffett what he is today, right? So he became actually a billionaire, millionaire and above only after he crossed 55 years of age, because for the first few years he simply kept on investing and compounding, and with the effect of compounding, today he is one among the top 3, top 4 richest men in the world, right? That's what is the possibility, right? So that is the great thing about this value investing. So how do we kind of do it? So there is around 7 to 8 steps to follow. Very simple step. Please have a look at this, and I'll kind of go one by one, and you simply have to adapt that. Now, apart from the stocks which I gave you, which is Bharat stocks or Ritik stocks and other things, you can pick up the stocks yourself outside of that family. It can be even small caps, mid caps, does not matter, right? So what are the criteria you will use? These are the criteria. So there are 7 criteria. The first one is you have to look at the quality rating of the company. That should be B or better. There are various quality rating. It starts from the topmost is AAA plus, then AAA, then 4As, and various things, and C, D, DDD, CCC. There are various levels of rating which is given. Who gives this rating? It is given by the credit rating agencies. There are around 3 agencies in India. We don't have to go to that level now, but they are the ones who give. So every company will have that rating, right? So if you simply go and Google about what is the rating of this company, it will kind of pop up. Or if you go to moneycontrol.com, there also you will get moneycontrol.com, and just type that in the search window, type that particular company's name, you will kind of neatly get that. Very, very simple. It's not a rocket science, everybody gets. So quality rating of the company, it should be B or better. In the US, it is done by S&P rating. It's also called as S&P rating. So there is subsidiaries of S&P ratings are all in India. CRISIL is one. ICRA, I think, is the other one. So there are 3 of them or 4 of them in India. Anybody who rates, that is kind of good enough. So look at B or better. B or better. Don't go anything lower than B. That is the first thing, quality rating of the company. Second, debt to current asset ratio. Now, what is this debt to current asset ratio? Which means debt means how much of loan the company has, and to fulfill that company, do they have sufficient current asset? Not all the asset, current asset. Why current asset? Which means is the business generating enough cash through which it can repay the loans? So that debt to current asset ratio should be less than 1.1. If it is more than 1.1, their ability to quickly nullify the loans is not going to happen. They're going to remain in loan for a longer time. The more the time they're remaining in loan, which means they have to pay interest more, which means the profitability of the company will go down. As an owner, your dividend and the value of the shares appreciation will be that much lower. So debt to current asset ratio is the second value investing criteria, which should be less than 1.1. That is the second one. Third one, current ratio. It is called as current asset versus current liabilities. Always the company should have more of current assets than current liabilities, which means which also is healthy with respect to its working capital. If that is more than 1.5, should be more than 1.5. Current assets divided by current liabilities should be more than 1.5, which means it again generates enough internal funds to manage its own business. Its need to go outside to get the funds is lesser. So which means the business is generating good money within the organization, right? Otherwise it's of no use, right? If the current liabilities are increasing and the current assets are low, which means it's in trouble. Working capital is kind of going down. I've explained what a working capital also is, right? So we want a healthy positive working capital. That's why current ratio is very, very important. Fourth investment criteria, value investing criteria, is it should have positive earning per share for the last 5 years. It has to be positive. If any of the years is negative, ignore that. And the most recent years, last 2 years, should be higher than the last 3 years. Out of the 5 years, all the 5 years should be positive EPS. It should have generated positive EPS, and then it should be in a growth mode. Every year it should have kind of kept growing. And the last 2 years, that is the fourth and the fifth year in your calculation, has to be highest. Fifth has to be the highest, followed by fourth, and so on and so forth. If second year is great, then it has tapered down, which means they have not done good, right? So you want to be in that company which is in the growth mode and doing good. That is why you need to have the right earning per share, right? Next is price to earning ratio, PE ratio. So which is again a very, very, very common ratio, which is kind of looked at for investing. So PE ratio of 9 or lesser, 9 or lesser, based on what is its current price to its current earning. PE ratio, it's very easily, you can kind of, all of these ratios you don't have to calculate. All of this is available. Just Google or go to moneycontrol.com for that particular company. Everything will be listed. So price to earning ratio has to be less than 9. And now price to book value. While some of them argue that price to earning itself is good enough, you don't need price to book value. But at times the earnings can be misleading. It can be 1 or 2 years, it can be like that. But book value does a much more broader analysis over many years, and then the book value is ascertained. So price to book value will give you a better judgment as well. So that ratio should be less than 1.2. Price divided by book value should be less than 1.2. And finally the seventh value investing criteria is dividends, which means it should currently be paying dividends. Last 1 or 2 years it should have paid, and it should have the plan of paying dividends even for the next year as well. So why? Because not only your value of the shares will increase, but also you will get some income. And if it is a dividend paying company, which means it is a healthy organization, it is generating enough profits which it can share with the shareholders. So it becomes very, very, very important. So these are the 7 criteria, value investing criteria, which was propagated by Benjamin Graham, who was a very close friend and who kind of shared all his knowledge with Warren Buffett, and Warren Buffett kind of used this kind of system to generate his wealth. So you could kind of do that. So when you're selecting other sets of stocks, use these 7 criteria, and basis these 7 criteria, you can kind of select those stocks which kind of fit into these criteria is also can be part of your investing portfolio. So hope you kind of got something out of this value investing understanding, and this is kind of good enough. You don't need any further rocket science. If you just do this and stick to this, lot of companies will get, unwanted companies will get eliminated, and you will be with the right set of companies for you to invest in. So hope you kind of got value investing, and if you kind of got and ready to kind of use this, type in the comment got value investing. Awesome. I'll see you in the next video where we will jump on to the trading systems.